And off we go on another discussion in Accounting 1120 on partnership accounting. My goal today is to look at the admission of a new partner. Yay, somebody new to play with. There are two ways that this can take place. One, the new partner can buy a portion of an existing partner's interest, or two, they can contribute cash directly to the partnership and become a new member that way. So, these are two different situations. Let's take a look at them, starting with the first one. Wow, look at all these facts. We have, in our first example, again, we have someone buying a portion of an existing partner's interest directly from that partner. So, right here it says Partner C purchases 50% of Partner A's ownership directly from Partner A. Now look at our partnership balance sheet. Under Partner's Equity, we have capital balance in A's account of $200,000, and Partner C wants to buy half of that. Let's further assume that he's going to do that for $90,000. He's going to give that money directly to Partner A. Partner B, of course, has to agree with this because we're letting somebody new into the partnership. But get a load of this entry. We're going to take capital A's balance, and since he's sold half of his interest, I'm going to reduce it by 50% and give it to capital Partner C. And we never get the cash because it's a transaction between Partner A and Partner C. The only thing that's happening on the partnership's books is a transfer of 1/2 of Partner A's balance to the new partner. And when it's all said and done, we'll have capital balance Partner A's account of $100,000. Capital of Partner B will remain unchanged at $175,000. We'll have a new partner, capital C, and they'll have $100,000. And it was $375,000 before the transaction, and it was $375,000 after the transaction. The partnership didn't receive the funds. It was a transaction between Partner A and Partner C. And it's true, the old partnership is dissolved, and a new one is formed. One with partners A, B, and C. This probably wouldn't be apparent to outsiders. It would happen internally with this journal entry. So that's example one, where you buy a portion of an existing partnership's interest. The next thing I want to look at is when you have the new partner contributing cash directly to the existing partnership. So, in this example, we have a new partner contributing cash directly to the partnership. We're going to do 3 scenarios where the new partner pays exactly book value first, and then the new partner pays the existing partners a bonus. He really wants in. He's going to pay for the right. This business exists and there's some value in that. In the third scenario, the new partner is paid a bonus to come in. He has some talents that the old partners want. In our second scenario, remember, the new partner is bringing in cash, so both assets and partners' equity are going up. We're not just reallocating existing partners' equity. First of all, we're starting with the partnership. It has 2 partners, capital A, capital B, $200,000 with Partner A, $100,000 in the capital account of Partner B, for total existing capital of $300,000. That's where we're going to start. And I want to analyze now, like I always do, analyze what happens and then come up with a journal entry. The new partner is there's going to be new cash coming in the amount of $100,000. So when this is all said and done, there'll be $400,000, the new capital. It's the new capital amount. 300,000 of old and 100,000 of new. And partner C is going to own 25% of that. So let's calculate what his partnership balance will be. Partnership C, you say that fast, balance, 25% of 400 or $100,000. So he's getting $100,000 worth of equity and paying $100,000 for it. Now we've analyzed it. Let's make our entry. We're getting cash of $100,000, and the partner C is getting a capital account of $100,000. He's getting as much equity exactly as he's bringing in. And that's the first example, recording the transaction and having it happen at exactly book value, meaning he paid $100,000 and received $100,000 worth of equity. That takes care of number one, brought in exactly book value. Let's look at number two now. We have a new partner contributing cash directly to the partnership, and they're paying the existing partners a bonus. So, where are we? So we have a new partner coming in, and he's going to pay $150,000 for a 25% interest in our partnership. And let's go with the same facts. We have capital in partner A's account of $200,000. We have capital in partner B's account of $100,000. So the total existing capital before this transaction is $300,000. The new cash is going to bring in $150,000 because that's what the new partner is going to give. So total capital after this transaction will be $450,000. While our new partner, partner C, is coming out with a 25% ownership. What's 25% of $450,000? Calculate that out, and it's $112,500. So now we've analyzed the transaction. Let's record the entry where you see the new partner paying the existing partners a bonus. We know the cash is $150,000, and we know that the capital for partner C, when it's all said and done, is $112,500. The journal entry doesn't balance. We're out of balance by the amount of bonus that the new partner paid the existing partners. Let's assume that the existing partners split incomes and losses 50-50 according to the ratio, partnership ratio. This is just another gain, so to speak. Capital A and capital B will each split that, and since the profit and loss sharing ratio is 50-50, each one will get half. Figure out what the difference is, divide it by 2, and it's $18,750. So the new partner is paying $18,750 more to the existing partners to join the partnership. Why would he do that? It's entirely possible the assets are undervalued, because remember they're at cost, not at fair market value. Or maybe it's a really good partnership and he just really wants in. There's a variety of ways that could happen, but we just looked at an example where you have the new partner paying the existing partners a bonus. We had one more to do. If you'll recall, the third one, so we have the existing partners paying the new partner to join them. He has a talent they really want, and they're going to give him a bonus for coming. This example, partner C is paying $75,000 for a 25% interest. So we need to analyze where we are so we can make an entry. Remember, analyze and then journalize. So, our existing partnership has $300,000 in it before anything happens. The new cash coming in is going to be $75,000 coming from Partner C. So when it's all said and done, total capital after this is going to be $375,000, of which Partner C is going to own 25%. Take 25 of the 375 and you'll see that it's 93,750 is the new partner's capital balance. So we know how much cash is bringing in, $75,000. I need to leave a couple lines here. Capital for the new partners going to be 93,750, and the old partners are paying him a bonus. Going to have to drop their capital accounts by the difference. And remember, they're 50-50 was their sharing of profits and losses. 50% of the difference will have each one absorbing $93.75. That's the difference between $75,000 and $93,750. Check the math on that. The difference is 18,000 something, 750, and we split it in half between the two new old partners, and they're paying the new guy a bonus to join them. And here's our journal entry that allows that to happen. And again, this is a case where cash is paying directly to the partnership, and assets will go up and total capital will go up. So in all cases, we figured out where we were, where we would be after the transaction, took the new partner's interest, figured that out, put that in a journal entry, brought in the cash, and then we knew what to do with the difference between the existing partners, whether they were paying a bonus or being paid one. This is how you admit a new partner. A happy admit, always. But you know, things turn sour in partnerships, and we're going to have to boot somebody. That's coming up next. Join me for the drama.